Credit Suisse, one of the largest and most prestigious banks in the word, faced a series of scandals and losses involving two of its clients, Archegos Capital Management and Greensill Capital. These events eroded its shareholder value and reputation, and forced it to overhaul its business strategy. Archegos Capital Management was a hedge fund founded by Bill Huang, a former star trader who had been banned from trading in Hong Kong for insider trading. Archegos used borrowed money to make huge bets on stocks such as CBS, Discovery, and Chinese tech companies. Credit Suisse was one of the banks that lent money to Archegos, along with other Wall Street giants such as Goldman Sachs and Morgan Stanley. However, in March 2021, Archegos' bets turned sour when the stock prices of its holdings plummeted. The hedge fund was unable to meet the margin calls from its lenders, triggering a $30 billion fire sale of its assets. Credit Suisse was the worst-hit bank, losing $5.5 billion in the debacle. The bank was slower than its rivals to liquidate Archegos' positions, and had inadequate risk management and oversight of its prime brokerage unit, which catered to hedge funds. Greensill Capital was a financial services firm that specialized in supply chain finance, a type of lending that helps companies pay their suppliers faster. Credit Suisse marketed funds that invested in loans arranged by Greensill to its wealthy clients. However, Greensill's business model relied on questionable practices, such as lending to companies linked to its founder Lex Greensill, or to companies that were on the verge of bankruptcy, such as GFG Alliance. In March 2021, Greensill collapsed after losing its insurance coverage and facing fraud allegations. Credit Suisse froze $10 billion worth of funds linked to Greensill, exposing its clients to potential losses and lawsuits. The bank also faced regulatory scrutiny and reputational damage for its role in the scandal. The twin crises of Archegos and Greensill shook Credit Suisse to its core, leading to the departure of several senior executives, including its chief executive Thomas Gottstein and its chief risk officer Lara Warner. The bank also announced a major restructuring plan, which involved dropping its prime brokerage unit, reducing its investment banking services, and focusing on its wealth management business. The bank also said it would strengthen its risk management and controls, and claw back bonuses from some of its employees. Credit Suisse's troubles are not over yet. The bank is still facing investigations from regulators in Switzerland, the UK, and the US over its involvement in Archegos and Greensill. It is also facing lawsuits from investors who lost money in the funds. The bank's share price has fallen by more than 20% since the start of the year, making it one of the worst-performing European banks. The takeover of Credit Suisse by UBS has sparked a wave of legal actions from shareholders and bondholders who feel they have been treated unfairly by the Swiss authorities. Among them is Qatar's Sovereign Wealth Fund, QIA, which was the second-largest investor in Credit Suisse before the deal. QIA had invested in Credit Suisse since the global financial crisis of 2008, when the bank was seen as a potential winner among its troubled peers. However, a series of scandals and missteps eroded Credit Suisse's value and reputation over the years, leading to its collapse in March 2023. QIA stands to lose about $330 million on its equity stake in Credit Suisse as a result of the sale to UBS, which was done at a fraction of its market value and without a vote from shareholders. QIA also holds bonds issued by Credit Suisse that have lost value and face uncertainty over their future payments. QIA has explored seeking redress for its losses from the Swiss authorities, who orchestrated the rescue of Credit Suisse and approved its takeover by UBS. QIA has sought legal advice on whether it has any claim against Switzerland, including through international arbitration, under a treaty that lays out a process to settle disputes. However, QIA has not yet decided whether to pursue a claim or not. Its legal options remain in an exploratory phase and are not being actively pursued at this time. QIA has hired a law firm that specializes in international arbitration and has offices in London and Paris to advise it on its potential course of action. QIA is not alone in challenging the terms of the deal and seeking compensation for its losses. Hundreds of lawsuits have been filed by other shareholders and bondholders of Credit Suisse, who argue that they have been deprived of their rights and interests by the Swiss authorities. Some of the lawsuits allege that the Swiss authorities acted unlawfully and violated their fiduciary duties by forcing Credit Suisse into a fire sale without proper due diligence or disclosure. Others claim that the Swiss authorities failed to protect the interests of creditors and minority shareholders by approving a deal that favored UBS and left them with little or no recovery. The legal challenges pose a threat to the stability and finality of the deal, which was meant to end the crisis at Credit Suisse and create a stronger banking giant in Switzerland. The lawsuits could also expose the Swiss authorities to significant liabilities and reputational damage if they are found to have acted improperly or negligently. The outcome of these lawsuits is uncertain and could take years to resolve. The plaintiffs face various hurdles and defenses, such as sovereign immunity, jurisdictional issues, contractual clauses, and evidentiary standards. The defendants, meanwhile, will likely argue that they acted in good faith and in the public interest to save Credit Suisse from collapse and prevent systemic risk. The saga of Credit Suisse's downfall and takeover is far from over. The legal battles that have ensued will shape the future of Switzerland's banking sector and test the limits of its regulatory framework. For QIA and other investors who have suffered losses, the fight for justice and compensation is just beginning.